Okay, welcome everybody. Thanks a lot for joining in today. I'm Giuseppe Basile, and I will be your host today in this FibStalker 7th Street weekly show. This is a weekly show, 7 p.m. EST time in Toronto, and you can watch the recording, of course. And today is December 28, 2016. We are almost at the end of the year. And if you've been following me for some time, you know that I always do an educational piece at the very beginning, the first part of the show, and then I review some markets. And today I'm going to review the same markets as last week. Last week and the beginning of this week has been slow for me. And I hope you spent a great Christmas, and you're spending your holiday season with your friends and loved ones. We're all going to relax and then start again the new year. So this is me. I'm also known as the FibStalker. So thanks a lot for joining in. If you are watching the recording of this video, and if you're watching it live, I want to remind you that risk is trader's job number one. Risk is really, really very important for me. And in this video, I'm going to offer views on up-to-date views on current markets. And this information is only merely provided to you for your general information, and might not take into account your individual situation. All right, so this is the disclaimer. Welcome, FX Ambassador. We have Desi. Thanks for joining in. About myself, I started investing rather than trading in 2001, and then I committed to trading and understanding technical analysis in 2001, 2003. I have committed, I was already doing my own research, but I only discovered in 2006 the importance of mentoring. I've been mentored personally by Van Tarp, Ivica Jurasic, David Asley, and I actually explored and studied the work of other traders like Jody Napoli and a number of others. I've launched FibStalker Trading in 2012. I have a high-performance coaching program called the FibStalker Master's Coaching Program. And this is not a course, it's a program, 12 months program. And although you get the core of it in the first 3 months, the subsequent 9 months help us working together to consolidate your trading to get you into profitable first and then consistent trading. I also started the Trading Signal service. If you want to try the service for free, one month, you can jump on my newsletter. I'll give you the information. You can go to FibStalker.com on the right top left side. You'll find a link to subscribe. So there's also a link for the newsletter here, eepurl.com and pv6ml here. This is the one, and I'm going to check here. Thanks a lot for joining. I'm going to also activate my my charting and as well as possibility to annotate here. So bear with me. In the meantime, FibStalkerTrading.com is my main website. I also have a community at winningwithalgos.com here. Just give me a moment to connect here. And you can reach me at FibStalker@gmail.com, also on Twitter. And we're going to start here shortly. Bear with me. I did get some time to research in tech analysis, and I published some works for the Canadian Society of Tech Analysts and the Italian Society of Tech Analysts, which are all both part of the International Federation of Tech Analysts. Here are some of the work and partnership I have. All right, so in this first part, here I'm going to cover another part of my series, 10 Steps to Successful Trading. And if you bear with me here a moment, the step 3 is mastering a trading edge. And this is very important, of course. A lot of people only focus on this point, but this is only one of the 10 steps and areas that you have to master if you want to become successful in trading. So let's get into it here, and I'm going to do now. I'm just going to just want to make sure that let me see. I'm going to share the screen here. Bear with me 1 second, and should be ready to go. If you like the series of 10 steps to successful trading, please feel free to link it on your Twitter, and as this can help other traders as well. So let's get into the importance of the trading edge. And talking about trading edge, there's a free course I have. It's available to everyone. Just go to winningwithalgos.com. It's a 6-hour video course on how to use algos to your advantage. So welcome. Thank you, everybody, for joining today. Welcome to FibStalker Trading, Simple Trading for All. And in this series, we talked about the journey. We talked about the 10 steps. And at the end of this series, I'll give some recommendations. So really, the journey, it's made of milestones here, and ideally we want to get from the point where we are to a point where we are profitable and consistent. As you know, we'll need to change a few things, particularly behavior, routines, and most importantly, beliefs. Trading is not a job. In fact, it's a business, and trading as a business is also a fundamental part of my 7 pillars for trading in modern markets. My recommendation is to not just try to make some money quick bucks, but rather learn skills that will serve you for your life. And the reason why 95% of traders never learn effective skills, the reason why 95% of traders lose consistently in the market is because they never learn effective skills. So these are the steps. Today we're going to cover number 3, but as you know, there are 10 steps, and number 3 is the mechanics of a valid trading edge. So let's look at what is a trading edge. Well, trading edge is no more than the method that you use to identify setups that you want to trade. Now, once we have identified setups, of course, we need to have also a methodology to prove that the setups are indeed valid, meaning that there is actual the participation from smart money and from professionals that we anticipate in that area for us to take a position. And I believe every the system should have a confirmation process. Call it timing, call it filter. You can call it as you want, but it has to be something that gives a confirmation signal. Because as we now know very well, and you can review step 1, the market can do anything, and without a confirmation process or confirmation technique, we put ourselves at unnecessary risk. So we need a trading edge, a method with a positive expectancy. If you don't know the meaning of expectancy, I'm going to explain that in a minute. It's very simple concept, but very, very important concept. And so as part of you becoming a successful trader, you will need to learn the mechanics of a robust trading method and develop a trading edge. This is usually the component people focus on the most. The problem is that it's likely that if you have been trading for a while, that you have actually stumbled upon a method that has a positive expectancy, that has actually shows a trading edge. The problem is that we as people sometimes don't let this method work because we are impatient, we don't follow simple plans, because we do not realize the statistical validity of methods that actually show their validity only on a relatively large number of trades. So it's one of the reasons a lot of people just focus on the method. They tell me, give me the rules or give me the signal, I'll take care of the rest. Really, this is only one of the 10 steps. So if you only have a good method and you don't have the psychology in place, you don't have money manager, a number of other things, you will very difficult you'll be able to reach trading success. So it is relevant, but not necessarily the most important. And again, you probably stumbled again or used in the past a good method, maybe not a great method, but a good method that gives you a trading edge. However, the reason why you are probably not able to trade it is because you have not developed the confidence and discipline to use it to generate a consistent result. And this is very important, the key in consistent trading, in successful trading, rather. Now, when I speak about a model or trading edge, we're really talking about the mechanics of trading, how the market moves, how we identify the setup, how we identify the areas where we want to get involved. And using timing technique, like for example, FibStalker timing, we can look at whether we want to get involved. Okay, so identifying the trading edge kind of put together all these, but not only identify the areas or the setups, but it's also identified precisely what is the step-by-step, the procedure that we follow to time these entry areas. So one or more trading system to identify setups. This is what we need. The trading system is a set of rules that allows us to generate a trading plan. Sometimes people make confusion between trading system and trading plan. Trading plan is an output. A trading system is really the input rules. And when we put through these rules the price data, we get the outcome, which is a valid trading plan. It is very important that we understand how significant players are positioned in the market. I've talked about this a little bit lately, and as you know, I follow two, or try to track and represent also on prices, on charts, two significant players. The first group is the smart money. The second group is the dump money, and it is very important to kind of build a map, a mind map, if you wish, of how these players are positioned in all time frames. It is very, very important to successfully trade a setup. Of course, as part of the mechanics of trading or trading edge, you need a timing technique, which tells us when to enter a valid setup. So the fact that we have a valid setup doesn't mean that that setup will be participated. And we don't know that until we test it, we prove it by applying a timing technique. I apply and use the FibStalker timing, which basically uses the same concept that I use to identify how algorithms are positioned on the larger time frame. It is applied on the smaller time frames, and as we know that algos even trade against one another on different time frames, we can use that mechanism for timing. Very effective timing as well. And the mechanical trading also includes a basic position sizing, so how much we wage, and I'm always surprised of how many people risk real money, also sensible amounts of money in the markets, and they don't even know the basic rules to actually position themselves in the right way to calculate the size of their position. And of course, as a result, when they don't do that, they don't know how much they are risking, which is very, very risky itself. In fact, in the past, in past step 2, we spoke about risk. It's not that the markets are inherently risky. The trader or the investor are risky, not the system or the market, because not understanding risk and not managing risk makes the whole game riskier. Again, the 7 pillars of trading in modern markets. When we speak about the mechanics of trading, we're really focusing on this part of the model here. We have the psychology of the market, the method, the timing, and a basic money management. Money management can be extended and expanded, and we're going to do that to prove how we can use money management to actually reach objectives in trading. All right, so how do we master a method? You need to learn basic but important trading metrics before you master a method in order to evaluate that method. And I mentioned the expectancy before. It's one of the key concepts here. And together with expectancy, we have reliability, which is really the number of winning trades divided by the total number of trades, and that's the percentage of winners, if you want. 1 minus the reliability give us the percentage of losers. Okay, so 1 minus reliability actually equals the percentage of losers compared to the percentage of winners, because anyway, winners plus losers, they have to be equal 1, which is 1%. Okay, sorry, 100%, of course. Expectancy, on the other hand, can be defined as the dollar gained in average for each dollar it is risked. Now, I'm not going to get in this quick webinar here into explaining how we go with the calculation expectancy. I've done that in a number, probably in a couple of webinars, and you can find them on FX Street. What is important to mention here is that this is a measure that actually tells us how many dollars we are doing for every dollar that we risk, and this measure expresses how good is our system. If you're making $2 for every dollar we risk on average on all trades, well, that's a very good system. If on the other end we are doing 20 cents for each dollar we risk, well, I wouldn't trade this system, because what I make compared to what I risk, it's not. There's a big imbalance here. Okay, so normally we want something around 1 or bigger than 1. The bigger, the better, of course. Another important measure which is derived from the expectancy is the expectancy, which is really the expectancy times the number of opportunity in a specific period of time. In this case, I'm considering 1 month here. So obviously, the higher the expectancy, the better. The higher the frequency, which means the higher the number of opportunities or trades that satisfy that specific method, that specific trading edge are generated, the better we are in the long term, and the better we are trading this system. Okay, so very, very simple concept. An outstanding and incredible number of people do not know that their numbers do not know what they are really trading, and this is key. Trading is a business. You have to know these numbers. So performance improves when you start measuring. Someone said that it's very, very important. So not only these numbers help you really understand what you're trading, but they also help you understand how you're doing if you're trading a system with this measure, because you can measure your sequence of R multiples, which is the results that you get for your own trades, you can compare them with the figures and metrics and measures that are expressed here. All right. So the simple metrics above allow measuring the quality of a method, but as I mentioned before, they also allow you to measure your own trading, how you are performing, and so by measuring that, we can improve, because performance improves when you start measuring. So it's very, very important. So number 1, you need to know your method. Number 2, you need to know your performance. And when you know both, you can actually generate information that you can use to improve your trading. So the key of a good method is not really the high reliability, but high expectancy. I mean, we can have methods that win a lot, let's say 80% of the time, but they're very poor in their expectancy, while we might have systems that win only 50% of the time, and they can have an expectancy which is 1 or bigger. So remember this reliability, or how right you are, how frequently you are right. It's not the most important measure. The most important measure is always expectancy, and the higher expectancy, the better. So um, a trading edge method can be described by these key concepts or key measures here, which also explain and clearly in numbers that there can be losses if reliability is not 100%, as usually it is in every system. Then you need to learn to live with losses, which are a fact of trading. All right, so we look at those trading metrics, and I want to offer here some example of what this trading metric could look like, so you have an idea. Particularly, I'm applying this to the FibStalker method signals, and these are based on my experience on what you can expect in the long term, in average, from the use of FibStalker methods and signals. Now, the metrics here are provided for both full risk and risk-free. Again, I'm not going to explain what risk-free trading is, but if you go in my page, and if you go on FS-Trade, you will find a very good and simple explanation of risk-free trading. Okay, the point is that when we use risk-free trading, we exit half of the position as soon as our gain, paper gain, equals our risk, and that's what I call a risk-free. I call risk-free trading, and that's what I call a risk-free position. And the advantage is that position then goes back and stops us out. We never move the stop. Then we end up at break-even plus cost of trading. So when you look at the FibStalker methods and when you use full risk on swing trades, that's the kind of reliability we have to anticipate. 60% with an average of 2.5 unit of risk in gains. And whenever we lose around 1 R. Sometimes we can lose 1.1 unit of risk. And in terms of opportunity, which is that frequency I mentioned before, we are between 5 and 8 opportunities in average per month. Sometimes they can be higher. And this is following, the 30 major markets, including 4 futures and 26 forex pairs. Okay, and the futures are S&P E-mini future, the dollar index futures, and then the mini gold and mini silver. Here you can use the larger contract as well. Now, when it comes to risk-free, and and here the expectancy is a little bit higher than 1, with an opportunity of 7.15, around 7 units of risk per month. And the average number of opportunity would be between 6 and 7 here every month. Now, when we use the risk-free approach, the expectancy goes down because we exit some of the positions, half of the positions, and of those 40% of loser, now we will have 20% that will close at break-even, and at 20% that will close as losers. And because we use the risk-free approach, now our winner that never stops us out have a return which is less than 2.5. In fact, it's 1.75. It's risk-free return. So when we compute all this, we have an expectancy around 5.5, which is not bad. The expectancy is below 1. The good surprise, and really where a lot of unit of risk can be accumulated every month, is when we consider the risk-free using intraday timing. And when we look at that, we have something like this, 40, 30, 30 here, whereas we have a smaller number of winners, but the the average return goes much higher. We have 30% of break-even and 30% of loser here, because we are very aggressive timing on the 15 minutes or 1 hour. Despite that, the expectancy is higher, 1.3, with an expectancy that can reach around 40, and also the number. And the reason is that. So the reason for this are basically there are two reasons for that. One is that the average gain of winners is higher, and the number of opportunities much higher. In fact, we have 30 opportunities in average. All right, so this is, to recap, how we consider our trading edge. We described what a trading edge is. Allows us to identify opportunities as well as timing. It's basic position sizing in it, and it's very important to reapply and take those valid setup only after timing and confirmation, and before that, after we have analyzed the market. In the 7 pillars of trading in modern market model, we are in the upper right side of the model here. To master a method, first we have to understand it, and to understand it, we have to apply some measure. We looked at reliability, expectancy, frequency, and opportunity. And we know that with this measure, we can measure the method itself, but we can also measure ourselves. We can measure our performance. And only when we measure, we can start improving. And that's very, very important. A key for a good method is not high reliability, but rather expectancy. And we know that there's no method that offers 100% reliability. Finally, we looked at some of the performance that you can reach with the FibStalker method. So if you want to get more information about the FibStalker methods, reach me out, and I'll be starting a new session of the FibStalker methods coaching program in February. So if you want to get involved, let me know. Drop me an email. And this concludes the step 3 of the 10th step to successful trading. Thanks for watching. All right, next in this section, I'm going to review the euro dollar. And if you want to, and if you like this review, you can always link it to on Twitter. And so before I get to the charts here, I want to remind you one quick thing here, that if you want to look at how I select and do the analysis for the signals, you can, and trades, you can always come to winningwithargos.com/signals. I'm offering a 1 free month for of trial, so take advantage of that. So euro dollar. What we are seeing in the last few weeks, and I believe we are still in the process of profit taking. I warned in the last few weeks that not to get involved at lows here around the second target. I warned you 2 weeks ago, and as you can see here, there's some profit taking. So a lot of people have been captured, kind of caught here into this trap of seeing the price below lows. I also heard some commentator talking about that, but the fact that this is below lows doesn't mean that it's going to continue right away. In fact, this is also second target, and we are in this area. Profiting is very, very probable. We also mentioned the fact that the next measure move, the next area where algos and professionals would like to get involved here, is going to come around 104, 106, and particularly is going to be 106, 14, 106.10 area here. Talking about this level, the blue level that you see here. So if this market continues this week and next week and eventually gets into that area, that would be interesting to see, the interest of smart money and dumb money basically meeting each other here right at that 106.14. So that becomes, if the market gets there, that becomes a very interesting level that I would be interested to time. And as I mentioned, I never short this level right away or buy these levels right away. I always want to see a confirmation from smart money. In this case, we'll also have the support of dump money. So nothing really to do here in this market. In the smaller time frame, we have 50% that's traded to 104 to 25, which has the potential to push price into that 105 30 area here and eventually higher, right into that area, daily area that you are interested into. So be a little bit patient here. And this market, I believe, is going to offer us an opportunity to get involved for a continuation lower. And this concludes the analysis on the euro dollar. Thanks for watching. Okay, next I want to review the New Zealand dollar, US dollar, and this market has been moving after 50% short, has been moving towards the target of that measured move. That target has not been reached yet. I'm talking about the 68.51. There is also that lines up in an area of potential support from Algos, and the point is that the market has not traded that level, and I believe that that level has to trade if we want to see a continued move lower. I'll also think, but what I think is not really important. Mr. Market doesn't give a dime about what I think, but the current behavior might be showing that there might be no participation around the 68.50. So, well, I should say that, make no mistake, maybe at the very first test, this market has not been tested yet, this level has not been tested. We could get a bounce, but this might be something that it's not capable of reversing this market completely. So that means that any bounce that you're going to see before or after this current correction on the daily is completed is going to be only short-termed. So at the moment, what I'm looking at is the 69.85 level, and if the market gets there, and it could get there along with the euro dollar testing that 106.10 I offered before, we could consider a short in this market. So we will see what happens in this market. For now, there's nothing to do. I will patiently wait either this market moving 69.80 or waiting for a test of the 50%. And if this market just continues lower without offering us a setup, well, eventually it will. And in a way, it would be even better if it's a confirmation of a continued move lower. So patience is the name of the game here. And this is it for the review of the New Zealand dollar US dollar. Thanks for watching. All right, next, last week I reviewed the New Zealand dollar, Canadian dollar. I will continue on this week as well. I believe there are good opportunities in this market. Some people might believe that this market has found support from dump money here, and these 50%, which is definitely there. We cannot negate there is, but support from the monthly dump money here, plus there is support in this area, although it was a dirty setup that went rather to test the dump money levels here. So where this market can go, this market can retrace pretty a lot here. We don't know, and we will be waiting for some signals here. The problem I have with this market is that dump money on the monthly and weekly is still positive. I still believe that this market has to test the 50% retrace. So I will be looking for areas where I can short this market, and the area could be this one. I'd like to see something more solid where the dump money will participate as well, and I don't have that yet. That would be this area here, but the market might not get to that area as well. So you will find more support here. So we'll definitely need to get into a short here in a solid, strong short position. So this market could also retrace all the way the 50% here short, and that's something that we have to keep into account as well. So we'll see how this market is going to behave the continuation of this week and next week. If this level is tested and the market cannot move above 94.50 area here, then we will consider a short here and try to challenge the dump money here into 109, 090.70 here, and that's what we're going to look at in this market. And this concludes the analysis for the New Zealand dollar, Canadian dollar. Thanks for watching. All right, I saw that there is Justin as well, and there was a request there. Can you get due levels, please? FX Ambassador, he's asking for the pound versus US dollar here. So let's do a review here. So this market is currently testing the 50% level here from lows to highs, as you can see here, FX, and it is it is a possibility here that this market, you're very welcome, not a problem. It is a possibility for this market to retest the 123.89 here, where there is dump money here waiting for this price. So this could be a possible scenario. So possibly driving price into that 123.90 and then seeing some sort of participation there to keep driving this price lower. And this scenario in a way would be in line with what's going on in the other markets that are trading against the US dollar. So I hope that that helps FX, and if you're long, you could try to participate on the long side here for a couple of days. I don't know if this data here is up to date. I don't see the move higher there. So let me just see if we need to roll out data here, or if okay. So if you are short, this market is testing now. It seems to me here that there is a discrepancy, and let me see, and now I understand why there is a discrepancy. So give me just a moment here, and I just want to make sure that the data here is this data is up to date here. It's not stale or old data. Yeah, so it appears that there was stale data here. Sorry about that. This market is actually pushing lower in here, and it is still possible. A reaction around this level is still possible. If the market continues lower then below the 121.36, we could have a reaction. So from 125, which seems around this area here, that's a good shot. What I would do, I would try to bring it down to 121.30 area here, and then wait for a reaction higher. All right. So next and last market, I want to review the Australian dollar, US dollar. and this market has traded alongside with the New Zealand dollar, US dollar, and we got a nice short here, which eventually brought price into not only the first target, but there was an important development here in this market, because the bulls here are not interested in trading this market any longer here. The 72 this level here, 72.12, spears on the downside. So whatever move on the upside we get here, it is going to be only profit taking. I believe this market eventually will move below, eventually will move to 70, 78. In this market, FX Ambassador say I'm looking for 72.50 to join the shorts. That could be a good level there, and the reason for that is there'll be certainly some algos position around that area. The level I have is lower than that. It's 72.36. So if you wait for 72.50, that could actually be too late, but we will see what happens there. So 72.30 area here with support from dump money could be an area where to re-enter this market shorts. The bulls are not interested in holding this market, and so it's very probable for this market to revisit not only lows, but 64.09 could be the final target here. Of course, this market might offer multiple opportunities in shorts to take advantage of the continued move lower. So for now, the 72.36 seems a valid level to look at. All right. Okay, and this concludes the review of the Australian dollar US dollar. If you liked these reviews, please you tweet the link on your Twitter account, and that would be highly appreciated. So thanks for watching this webinar today. I want to remind you the contact information here, FibStalkerTrading.com. I have some premium products here that might be of interest. The FibStalker Coaching Pro is definitely their performance coaching to trade like smart money and dump money, and this is it for today. So thanks a lot for watching, and you have a great evening, and I'll see you next week every Wednesdays at 7 p.m. EST time in Toronto. Thank you very much, and have a great one. Bye-bye now.